Hello everybody, welcome back. This is again corporation tax as a chapter of business taxation. And today's chapter will be about the so-called interest barrier rule and the underlying problems. So we will have to talk much about the problem first, that due to certain tricks you may be able to choose freely in which state you want to pay your taxes, although you earned the money somewhere else. This is something which states cannot tolerate. There are two very important kinds of tax saving models which work into that direction. And the solution is, since all the two of them work via the deductibility of interest expense, the most perfect solution would be abolition of the deductibility of interest. In principle, the solution goes into that direction, although it is not so radical as you might presume, because you need a certain tolerance for interest payments which are really necessary and don't serve tax saving purposes. Well, so after we have understood the problem and how urgent it is, we can talk about the rules on the interest barrier in Germany in paragraph 4H ESTG and paragraph 8A KSTG, and then at the end we can have a glance on the common rules of the EU, which has introduced a common obligation to have interest barrier rules in all member states in order to limit unfair tax competition. Well, so let's have a look. What's the problem? Let's first look to how tax saving models in that area using interest payment would work. The two basic ones are as follows. The first one works as I explained you just now. Imagine you are a firm and you have a permanent establishment abroad and one here at home. So two parts of your enterprise. Then, under the double taxation treaty rules, the foreign permanent establishment will probably be taxed in the foreign state. That is usually to be found in Article 7 of the double taxation treaties. Usually they copy Article 7 of the OECD Model Convention. And your home state, for example Germany, will exempt the foreign income from the home state taxation. Now let's further imagine that the foreign tax level is lower than the tax level which you are used to at home. And let us assume further that you intend to make two important investments. Both will cost 100 million. Now you unfortunately only have 100 million at hand and you will have to borrow the other 100 million. Now it's absolutely clear you will have to pay interest for the second 100 million. The only question which you can talk about is now, for what are you going to use the credit and for what are you going to use your own equity? For the commercial profit of the whole enterprise, this decision makes no difference at all. Your net profit will be the same, or your profit from the enterprise, and the commercial law will be the same, because it's clear you have to borrow 100 million, and in my example that would trigger an interest expense of 5 million per year. So no problems here, no difference concerning the commercial side of everything. But now let's think about using your own money to finance the acquisition abroad and to finance the acquisition in the inland with the bank credit. Now we have the rule that business expenses are the expenses caused by business, and if you have two parts of your business or two businesses, expense of the German business is that what was caused by the German business. Expense of the foreign business is that what was caused by the foreign business, plain and easy. So if you take up the credit for the German investment, the inland investment, then the credit and the credit cost are caused by your inland activities, and so the interest expense belongs to the inland profit and lowers it. Whereas there, where you pay low taxes, no expense was made, because there you use your own money, so there the profit stays relatively high. So let's have a look here. In the first moment, we just lower our inland profit, so the high tax profit goes down. Now imagine a similar decision has to be made half a year later. Again, you think, where do I use my own money for, and where do I allocate the necessary credits to? And the answer is you allocate the interest to the inland, and so on, and so on. So that in the final effect, all the expense for financing costs is allocated for the inland, and the rest, your own money, is always used to finance investment where taxes are low, because there the profits are then kept undiminished. So you keep the favorable tax level, and you lower the tax profit where tax rates are high. Naturally, that is nothing which your inland fisc is going to like. They regard it as a bit unfair, but it can always be done. And that is what they want to fight. The basic effect here just works by making clever usage of the absolutely normal principles of tax law. A business expense is caused by business, and if it's caused by the German part of the business, the expense belongs to the German part of the business. And so you just have to coordinate your finance behavior in a way that you always tend, at least, to borrow money if you need it for inland activities, whereas you prefer to use your own money for activities abroad. So that if you tolerate that as the inland, then it's possible that in a globalized world, your own tax base can be brought down brutally. And so that's probably what you don't like. Tax saving model number 2 works in a different way. Imagine the owner of a firm has capital, and the firm needs that capital for investment. Now the owner would normally be expected to give that capital as equity to the firm, but now owner says, no, we are two different persons, we can conclude contracts, I give my money in form of a credit. In that way, the firm has to pay interest for the capital which it used, and accordingly, the profit of the firm goes down by the interest. That model is attractive if the interest in the hands of the recipient, so of the shareholder, causes a lower tax burden than in the hands of the company if that company had been able to keep the money. And by the way, that is a problem which you only have with companies, corporations, because a sole tradership cannot conclude interest contracts, and a partnership can conclude credit contracts under civil law, but they will not be accepted under the perspective of tax law. So the only institution which can make so you can only use that tax saving model with companies. Now, how does it work? Imagine you have a local firm, juridical person runs a firm, local tax rate 30%, and earns 10 million. Now, if that remains this way, they have to pay 30% on 10 million. And now there's a shareholder abroad, local tax rate only 10%, and shareholder now gives a credit and receives interest payment per year, let's say 5 million. What is the consequence on the society or company level? Now the profit goes down by the 5 million interest expense, and only 5 million tax base is left over. So we pay now only 1.5 million. the shareholder receives the money. Naturally, shareholder has also to pay taxes on that. Shareholders' taxes will be 500,000, namely 10% of 5 million. Now the total effect, if you sum it all up, the taxes in the country of the company go down by 1.5 million. The taxes of the shareholder go up by 500,000. Net effect is 1 million. Tax was saved by shifting that money to another state, just by the credit contract. That's highly attractive, naturally. Which effect does it have? You can now freely decide if you want, or you can always freely decide if you want to give your capital as equity to a firm or as a credit. And in the one case, it has the consequence that the profit arises in the country of the company. In the other constellation, the result will be the money becomes taxable in the hands of the shareholder. And so you can always opt for that solution which leads to the lowest tax rate. So if the tax in the state of the shareholder is 10%, the tax of the company is 30%, you want to get the money or as much money as you can into the hands of the shareholder and create expense on the company level. So it will come out exactly what we had before in the chart. Now, if the tax in the state of the shareholder is 30% and the tax of the company is 29%, then interest financing leads to a higher tax. Then you would probably prefer equity financing, because then you get away with taxing the profit in the corporation with 29% instead of 30% payment on the shareholder level. Now, one would already see from that, even in a naive perspective, that in such a world you always need to be the state with the lower rate of the two. So you have a tax rate competition between states. The state of the company would always be trying to become cheaper than the tax level in the state of the investor. And the investor state would try to become cheaper than the state of the company. That's not a very healthy thing for the fiscal revenue, naturally. And it's something which states want to limit or to avoid. Now, why is my first conclusion that you need to be the cheapest state of the two? For example, your neighboring state has 30%. Then the naive conclusion would be, okay, try to have 29, then you can survive. Why is that conclusion even naive? Imagine we have this constellation. A company has 39 and the shareholder 40. What will come out as tax level if they use our tax saving model too in a clever way? And the answer is not 39, not 40, but 10%. Why? Yeah. Simple thing. Shareholder first gives the money as equity, as a contribution to a newly founded company in Malta or Bulgaria, which have 10% tax rate. Then that company from Malta passes the money on as a credit to the other company. Then that company pays interest. So we have interest expense lowering that company's profit. And in Bulgaria here, as we have here equity invested, so no costs here, we have a full profit. And later the money goes up as a dividend to the shareholder. And receiving a dividend from a company in Malta is exactly as expensive as receiving the dividend from the company. So nothing changes here. The dividend doesn't change the total tax burden. It's irrelevant, because the tax of the shareholder on the dividend would have arisen in both alternatives too. And so you end up with 10% tax rate, although both states involved have 39 and 40. And here you see that tax saving model can even bring that money into a country which has absolutely nothing to do with where the money is earned and where the money comes from. And that is regarded as especially unfair. Naturally, one can understand that. So now the problem is that also shows you why this tax saving model makes states extremely helpless, because you can try to become cheaper than your neighbor state and another neighbor state, but there will always be one state left in the world which is cheaper than you are, and there is where all the money from all over the world will be allocated under that tax saving model. So highly dangerous thing. And so you can't survive without counterattacking that tax saving model. You can't be the cheapest state in the world. Somebody else would outbid you by a cheaper rate, and then all would be gone. You must do something against this tax saving model too. So what can be done? In both cases, the tax saving effect comes from the fact that remunerations for credits are deductible expense, whereas remunerations paid for equity capital, that's dividend, are not a business expense. So the decisive point is interest payments are a deductible business expense. Equity payments are not. So you can either set up a fiction that the interest payments are treated as if they were payments on equity, so you requalify them by fiction to dividends in order to remove the difference, or you declare that interest expense is a business expense, but it's not deductible anymore. With these two ideas, you can use them alternatively. Either you say interest payments are requalified as dividends if I don't like them. Then naturally, making interest payments can bring no advantage anymore over paying out dividends. Or you just say interest expense are interest expense payments, but they are just not deductible. So to say it clearly again, solution number one means certain credits, those whom you don't like, are treated as if they were equity, so they bring no interest payments anymore, but these are treated as if they were dividends. That is a solution which was popular in the 1990s, and this solution led to some technical difficulties and legal debates, especially the requalification of interest payments into something else, a dividend payment, could have been seen as a violation of Article 9 of most double taxation treaties, which says that contracts between a company and a closely related person are only adjusted, modified, or not acknowledged by tax law if the terms on which the contract was agreed upon are not terms which would have been chosen by independent parties. And naturally, all these credit contracts were precisely made as if they were made between unrelated persons. So that article was a stumbling block for correcting these things. So solution number two was developed. We accept it is interest. We don't attack the credit as such. We just modify our national tax base rules, and we just say this interest is a not deductible expense. The advantage were you have no problem with the DTT rules. The DTT says, yeah, you are free to design the rules for your own tax base. The only thing the DTT says is what you can tax and what not, and how you define the tax base and what is included and excluded. That is your own affair only, your own business. So if a DTT says business income of a company can be taxed here, then we are completely free to define the tax base, and we can say that certain expenses are not accepted as deductible. For example, we can say that interest is not a deductible expense. And so you achieve the same result basically, apart from having the problems with Article 9. So that is why this second solution was preferred during last decades. Why do both solutions destroy the attractivity of the tax-saving models in question? Well, imagine how the situation changes if interest is no longer deductible. So here we have 10 million earnings. 3 million are to be paid as taxes. We have the shareholder abroad. Shareholder gives a credit, gets interest payments. The shareholders, the company's taxes still remain 3 million because the interest does no longer lower the tax base. The taxes of the shareholder on the interest nevertheless have to be paid because it's still interest what is paid. And so if we now compute the total effect, we have the taxes of the company change in no way. The interest causes additional taxes of the shareholder of 500,000. So the total amount, total effect of that previous tax saving model is now an increase of the tax burden. And so people get a very strong incentive to avoid this construction now and in the future, naturally. As you can see from that new world here, now interest financing gets counterproductive. It is now damaging for your firm. Now the whole thing creates financial disadvantages for you instead of advantages. So you get very effective incentives for the firm to refrain now from credit financing and choose equity financing wherever they can. And this is naturally a very good effect which you wanted to achieve. Now there is naturally again a problem. The new rules effectively hinder people from taking up credits, but there might be cases where firms do not take up credits because they want to lower taxes, but because they genuinely need capital to work with, so they need the credit, and so you hinder their economic activity. Then blocking such credit financing would be counterproductive for your own economy. So you need a way to find out where should I attack interest payments as tax abusive or as at least dangerous, and where is credit financing genuinely needed. So here you need to find out where the line between what is okay and what is not okay, where that line runs, and let's think about that. With regard to the first tax saving model, the German solution is relatively easy. Tax saving model number one cannot be in play if the inland permanent establishment is the only permanent establishment which you have in the old complete group. Because if there is only the inland part of the firm, it's not possible to allocate all the necessary credits to foreign parts of the firm. So tax saving model number one cannot work in that context. If there are foreign parts of the group or of the firm, tax saving model two could be number one could be run. But if it had been run, then the equity ratio, so the percentage of equity invested in the inland parts of the firm, would be lower than in the overall average of the firm. So if you can prove that the inland part of the firm has as much equity as a percentage as all the rest of the firm, then this is a clear proof that you did not, or did at least not successfully, try to run tax saving model number one and allocate credits always to the inland parts of the firm. So in these two cases, one could easily say, okay, here is no need to limit the interest deduction, because in these two cases we can prove tax saving model number one has not been used. So here you could renounce on all countermeasures. Naturally, that leaves us with tax saving model number two. If shareholders give money which they have as credits instead of equity, how can we exclude this danger? Or we can state that this tax saving model has not been used if no shareholder has given any credits to the firm or to the group of firms. So if a shareholder has given credits to the firm or to the group of which the firm is a part, then we cannot be sure that the firm has not used one of the two tax saving models or even both. And if a shareholder has given credits to the firm, the non-deductibility of the interest should take place just out of caution. Now, every shareholder, really? That's a question. You can reasonably assume that somebody with one single share is not able to influence the firm's policy and to cooperate with the firm as somebody who sets up a tax saving model by credit financing. So you will need a major participation for that, a participation with a certain entrepreneurial influence. That will be restriction number one. And second, imagine a shareholder gives a credit to the firm, but the credit is 100 euro. That evidently does not matter. So we should decide that credits by shareholders only should spoil the whole thing if they reach a material extent, so if they are not completely unimportant at least. And yeah, so you can additionally say that a tax saving model has not been used if the firm gets interest, or as far as the firm gets interest revenue, because nobody would be so mad to say we kick money in form of interest expense to other countries and then we bring it back in form of interest revenue. Or if you have interest revenue collected by the German firm, a clever financing trick would always have it make possible to obtain that revenue in another country by another company. So when interest revenue flows in, that is also an indicator that at least up to that extent, interest expense does not matter, because you could have avoided the interest revenue even without the interest expense. So it's just fair to set it off against each other. So as far as interest revenue comes in, you can allow to have it passed on as interest expense, because you would have been able to avoid interest revenue in the first already. So that makes no sense. Okay. Then what happens next? What are the rules which then apply? Also, in the cases where a tax saving model might be in play, a certain amount of interest is tolerated, and so the idea of the German interest barrier rule is that if the interest barrier rule applies, then the net interest expense can only be deducted up to an amount equal of 30% of the earnings before interest, taxes, depreciations, and amortizations. So only an exceeding amount is non-deductible expense. That means, on the other hand, up to 30% of your Ebitda can be spent for interest expenses. Net interest expense, by the way, is my personal expression for the difference of interest revenue minus interest expense. So that interest which is not compensated by interest revenue, which comes in on the other side. Well, how would that work in practice? Let's learn probably most from cases. Example 1. X GmbH has a profit of 10 million, and during the computation of that profit, the following events were taken into account. You know that already, huh? That way to approach things. Interest revenue 1 million, interest expense 21 million. Depreciations and amortizations, which were made in the tax accounting, were 20 million. How high will the taxable income be in the end? Let's first begin with computing the tax profit, or the provisory one, but we have given it here already, 10 million. So the next step is checking if the interest barrier rules change the result by creating some non-deductible expense. The net interest expense, 21 million interest expense minus 1 million interest revenue. So net interest expense is 20 million, the expense which exceeds the revenue from interest. Now let's calculate the Ebitda. The Ebitda is a tax profit plus the interest paid, the net interest, 20 million, plus depreciations, another 20 million. So the total Ebitda is 50 million. You can use up to 15 million, 30% of that, in order to finance interest. The rest is non-deductible. So 20 million were paid here, 5 million not deductible. So the tax profit is changed from 10 million by elimination of 5 million interest expense to 15 million. An important thing which you should know is that under the German rules, you can carry forward that non-deductible interest payments to the future and can deduct them there if in the future you have more Ebitda or less credits and so, and therefore in the future you have some free capacity within the 30% Ebitda limit. So if you then change your financing habits, you can even recover that money which you now lost from the non-deductibility of the interest in the future. So the rule gives you a strong incentive to change your behavior in a way which is more favorable for the fisc and you. Example number 2 is a bit more in detail. Why GmbH has computed a commercial profit of 11.3 million, and during the computation of that figure, the following things were taken into account: tax expense 8.7, interest revenue 2 million, interest expense 32 million, depreciation, amortization 20 million. You know, we have already spoken about that, how you compute the tax profit from the commercial profit. So tax profit would be commercial profit plus taxes and the other non-deductible things which you have, 20 million. Now the last step is check the interest barrier. You have a net expense of 30 million. The Ebitda is therefore 20 million plus 30 million interest plus depreciations and amortizations, 70 million. 30% deductible is 21, paid was 30, so 9 million are not deductible. Your tax profit ends up finally with 29 million. And the 9 million non-deductible expense can be carried forward again to the future. If somewhere in the future your 30% Ebitda limit is not fully exploited by current interest payments, you can set off additionally some of these 9 million up to the 30% limit of that year. Another example. C GmbH, we have commercial profit 10 million, donations 8 million, corporation tax 6, trade tax 6, interest revenue 5, interest expense 45, demotivations and amortizations now 30 million. And what comes out? First, compute the regular tax profit. So computation commercial profit, add back the taxes and the donations because they are both non-deductible expenses in the first one, 30 million. Now the calculations which are necessary for the interest barrier. You have a net expense here of net interest expense of 40 million. The Ebitda is then 30 million tax profit, 20 million, 30 million depreciation and amortization. So in the end, you end up with 100 million indeed. Deductible is 30%, 30 million. You have paid 40 million, so non-deductible interest is 10, and so your tax profit goes up to 40 million after that step. Now the donations can be deducted up to 20% of the tax profit. That's exactly 8 million here, so they are fully deductible. The new tax profit is 32. A loss carry forward could be deducted afterwards, but there is no loss carry forward here. So happiness, our final result is 32 million. Now again another example, and it can only surprise the fewest among you, but after example 3 we have now example 4, and this is the GmbH. We get the following data as a starting basis for our calculations. Commercial profit is 13 million. Tax, corporation tax and trade tax is 6 million. Donations 1 million. Interest revenue 4 million. Interest paid 24 million. Depreciations and amortizations 40 million. Solution, what comes out? Provisory tax profit is commercial profit plus taxes because they are non-deductible expenses, plus donations because they are not yet deductible expenses. We can't calculate the 20% limit up to now, so we end up with 20 million tax profit. Net interest is 20 million, depreciation and amortization 40 million, so we end up with 80 million. 30% of that is 24 million. That's the limit for the interest. Net interest is only 20 million. Oh, surprise. So we have a remaining capacity of Ebitda, which could have been used for interest deductions of 4 million. So you stayed within the limits. That's highly positive. Now, some important thing which you should learn with that or from that example. German law says you can carry forward such an unused capacity of the Ebitda to up to 5 years in the future, and can then use that to offset additional exceeding interest of future years. And the rule is the exceeding interest is always set off against the oldest Ebitda carry forward, naturally, because otherwise it would expire unused. So, well, good. Imagine another example. Example 5, for year 8, we have the following data. Commercial profit 2.4 million. Donations 500,000. Taxes 2.1 million. Interest revenue 4 million. Interest paid 34 million. Depreciations and amortizations 40 million. So that's not everything. We got additional information. Each GmbH did in former years not always use up their Ebitda capacities. So they have an Ebitda carry forward in the result in year 1, 500,000. One of 2 million was left over in year 4, and one of 3 million was left over in year 6. So let's now start calculating the tax burden. The provisory tax profit is 2.4 million commercial profit plus donations reversal plus 2.1 taxes. We end up with 5 million. Interest barrier calculations, net interest expense is 30 million. The Ebitda is 75 million. 30% of that is 22.5 million. That is the limit up to which you can deduct interest. Now the interest paid was 30 million, so non-deductible amount is in the first step 7.5 million interest for this year. But we have still that Ebitda carry forwards from former years, which we can bring forward now. Year 1, unfortunately, that's too old, and Ebitda carry forward can only last for 5 years. Now we have year 8, year 1 is a bit old, so that Ebitda carry forward has expired, it's lost without being used. But year 4 is still within the 5 years limit, so that's the oldest Ebitda carry forward which we can use, so we use it, 2.0 million. So the non-deductible interest amount can be lowered from 7.5 by the 2 to 5.5 million. The next Ebitda carry forward which can come into play is the one from year 6. 3 million and 5.5 million are still left over, so we can fully deduct the 3.0 million, and we have only for this year, after using up the Ebitda carry forwards, 2.5 million. non-deductible amounts. So the resulting profit is 5 million tax profit plus 2.5 non-deductible interest expense of this year, 7.5 million. Donations are deductible up to 20% of that, so 1.5 million, paid for 500,000 only, so we end up with 7 million taxable profit. Corporation tax is, as you can see here, and by the way, the non-deductible 2.5 million can now form an interest carry forward to future years. Example 6 is the next one we have to talk about. Imagine F GmbH has an interest carry forward from 7 years ago of 1 million and one from 3 years ago of 4 million. They have a provisory tax profit of 100 million. Their depreciations and amortizations are 50 million. Net interest paid is 20 million. So we have an Ebitda of 150 and deductible limit 45. Net interest paid is 20 million, so we have still a remaining capacity for interest deduction of 25 million. This remaining capacity for interest deduction of this year can be used for deducting the old non-deductible interest amounts, so the interest carry forward. In contrast to the Ebitda, the interest carry forward is absolutely not limited in time. So, by the way, it makes no sense to separate the interest carry forwards with regard to from which year they are. So you can just add them up. And so we can just simplify our life by saying we have an interest carry forward of in total 5 million. So the remaining 25 million can be used for with 5.0 for the interest carry forward. Then the tax profit goes down from 100 million by the 5 million interest payments of former years to 95. And the unused Ebitda of this year, 20 million, minus these 5 years, 50 million, can be carried forward for up to 5 years in the future. That would be the solution here. Now you have already seen that that Germany grants an interest carry forward for all that interest which was declared undeductible. Why do we do this? Well, it seems to be a kind of unnecessary generosity, and the answer is, imagine you can't foresee exactly what will be your Ebitda of the current year. It might be that a crisis spontaneously ruins your profit situation. Then very easily you end up with having paid more than 30% of your actual Ebitda of this year. So interest becomes not deductible. That increases your tax expense, and that might ruin your economic situation even more. Now, if then the fiscal situation, the financial situation can be adjusted in the future years which are to come, then you can, in a certain way, save the tax saving effect of the interest again, bring it back, and so your loss this year is only a temporary one. Even under balance sheet accounting rules, under certain circumstances, it would be possible to neutralize the excessive tax burden if you can be confident enough that you can recover the tax deduction effect in later years. So it would not probably ruin your balance sheet results more than necessary. And another aspect, by this way, granting an interest carry forward, you give the firms in question a very, very strong incentive to replace the current credit financing by giving more equity. So shareholders will do everything to give more equity. And that is exactly what we want in the long run. Here now, credit financing is probably reduced, and here the tax department then even begins to tell the shareholders, yes, giving more equity is here just a tax saving model, because here you can minimize the economic damage from the interest barrier just by changing over to more equity usage in the future. So that has first, that shields you against unexpected harm, or it makes it possible to limit that harm, and it gives you a very good incentive to change your behavior. The other thing is the Ebitda, if it's not fully used up, why can it be carried forward? And the answer is, well, again, it can always happen that the Ebitda in a future year is less than expected. Now then you would directly be hit by the interest barrier. And a prudent merchant would always try to build up a kind of a protection or a reserve against this. And that is exactly what we allow you under the Ebitda carry forward rules. If you don't use all the interest payment capacity in 1 year, which you could have used by clever tricks and so, then you can use that as an emergency reserve for next year. So imagine you expected to have an Ebitda capacity of 20 million next year, but it only, due to a very, very bad situation in the economy, you only had 10 million. Then you could comfort yourself by saying, okay, I have 10 million left over from last year. So indeed, we are so happy that we will not be hit by the interest barrier in full, because we expected to be able to set off 20 million, and we can, because we have 10 million EBITDA of this year and 10 million which we saved up as an emergency reserve from last year. And so you might still avoid additional problems. And now you even have created by the Ebitda carry forward a good argument for a tax department to explain to their shareholders and investors and others why they didn't use the tax saving models concerning interest up to the last limit this year. They can even give it a good reason and say, well, we always try to be a bit away from the limit so that we can carry forward something for future years in case that next year something goes wrong and our EBITDA is strongly below what we have planned before. There is still another aspect which we should mention. But before, we should make a final overview, or a nearly final overview. Interest can only be deducted up to 30% of the EBITDA. There is a carry forward for unused EBITDA, and there is also a carry forward for non-deductible interest. That whole system of rules does not apply at all if you can talk yourself out of suspicion that you use tax-saving models. So if the firm stands alone and is not part of a group, or if the firm is part of a group but has at least a percentage of equity which is higher than the average percentage within the group, then it's also not a tax-saving model. And the most important rule of all, which we have not yet mentioned here and which is new now, the whole interest barrier rules do not apply under German law if, that does not mean as far as, but if the net interest paid by a firm does not exceed 3 million at all. So the if means if you pay not 3 million but 3 million and 1 euro, then the full rules will apply. Now, in case of a capital company, one has further to give proof that no shareholder of major importance, so beginning with 25% participation directly or indirectly held, that no important shareholder has given credits to the company, or that these credits, if they exist, are not material at all, so that they are less than 10% of the net interest expense paid by the firm. Plus, if the firm is part of the group, that also no other company in the group worldwide has ever received any important credits from important shareholders, so that there is no company in the group where the net interest payments to creditors who are shareholders make up more than 10% of what they have to pay in full as interest. Now there is a last aspect which should be mentioned. Apart from the German rule, there is, since 2016, also an EU directive which states that all EU states have to introduce an interest barrier rule. That is the Anti-Tax Avoidance Directive, or ATAD, from 2016 with later amendments. It's binding only for corporation tax, but one can reasonably assume that most member states, or at least some of them, will also extend the rule to income taxpayers. Okay, but the directive states as general principles that interest expense may only be deducted up to 30% of the Ebitda, then that the Ebitda has to be computed in a certain way, namely the tax profit plus adding back interest, tax as far it has not yet been made, depreciations and amortizations. Then the member states may, so they don't need to, but they may grant exemptions for the following cases. If the net interest is less than 3 million, then you can refrain from the application of the interest barrier rules at all. If the firm is a standalone entity, then you can also refrain from application of the rules. If the firm in question is part of the group, it can further be granted that either you refrain from the application of the rules completely if the equity ratio in that firm is at least as high as in the other parts of the group, or that you get an additional deduction of interest payments up to that ratio of interest in relation to EBITDA, which is usual in the group. You should note that in the directive, all these exemptions are an option for the member states, but not an obligation. So a member state could also, if they wanted to, bring the 30% EBITDA rule forward without any tolerance. So might be possible. The member states then also are allowed to grant one of the following three rules. That is evidently a kind of closed set of rules. You have to choose there. But you can also choose the no solution rule. Either an interest carry forward without time limit, or interest carry forward without time limit and interest carry backwards with up to 3 years in the past, or an interest carry forward without any time limit plus an Ebitda carried forward for at maximum 5 years present. German solution would be found there under letter C. By the way, here I'm not absolutely sure where there is the difference in the effect between an interest carry backwards and an Ebitda carry forward. But might lie in details. I'm not sure where the details are. But what is really surprising is the complete absence of the no credits given by shareholders condition in the ATAD. So the ATAD does not really fight the second tax saving model. It just remains silent on that, and that is surprising. However, Article 3 ATAD states that member states always have the right to establish more restrictive rules against abusive behavior than the ones which are laid down in the directive. So Germany can, in all probability, carry on to apply its rule, which also says, okay, the existence of shareholder-given credits spoils the escape rules, but it's surprising that this vital point of the whole rule has been overlooked completely or has been negotiated away during the negotiations for the directive. No? But naturally, Article 3 ATAD seems to be a strong argument to make such additional conditions legal under German law too. Yeah, I have come to the end with the interest barrier lecture here. Thank you very much for watching. It was probably a bit complicated today, Also a bit of chaos with my computer because I always had to restart the stuff. So I probably enjoyed it in the same negative way as you did, although for other reasons. Yeah, I would be glad to see you again soon, and till then, recover well from today's lecture, and I'm looking forward to seeing you again.